So, okay, taxes. Incomes taxes in the United States were instituted as we know them now in 1861. So, for nearly 100 years of the country's existence, it didn't have a permanent income tax, but it does now, and it started at a pretty low rate compared to how it is now. Initially, it was just a 3% income tax of anything over $800. And $800 then was quite a lot of money, more than it is now. That income tax was later reduced to 2% of anything over $4,000. So there was a while where the only people who were paying income tax, were those who had a salary of more than $113,000, and then it was 2%. So that would be uncharacteristically low if you look at where things stand now in the rest of the world. The United States is kind of maybe in the middle, and it's often the case that developed countries have higher income tax rates than developing countries. What this figure is showing is the top income tax bracket. So most countries have some form of a progressive income tax, meaning that people with a lower income pay a lower percentage. But what this is comparing is that, for whoever is making the most money in the country, what is the top income tax? And so, for example, you can see the United States in yellow. That represents between 35 and 40%. But there are countries where it's higher than that. Australia, for example, here shaded in dark green, that's between 45 and 50%. And then shaded in a much darker green than that is 50% or more. I think you can see that Sweden, the Netherlands, and Denmark.
There's a few in the middle of Africa as well.
That may be, yeah. It's hard to tell this black one from the dark green. The black one, Saudi Arabia, UAE, Oman, Kuwait. But tax rates vary a lot through the world. And of course, there's other ways to get income for the government than income taxes. They can have excise taxes or value-added taxes or property taxes. And so it doesn't necessarily have to be from income. And some people have suggested that you should tax things that you don't want more of. You shouldn't tax things that are themselves good, because taxation is discouraging that thing. And so by taxing income, you're in some cases discouraging people from generating income. And so I don't know what the right answer is, but that's where things stand. And if we just look at the income tax burden for the average family, meaning 2 adults and 2 children, middle income type people, this is a ranked list for developed countries that shows the United States effective income tax rate at the federal level is around 11% for a family with 2 adults, 2 children, and a typical average wage. But there are countries where it's more than triple that. You can see in Denmark, the family with 2 adults and 2 children would pay more than 34%. And I think part of the rationale for some of these countries is that they offer more in the way of services. And, in the United States, this 11% of your income that you're paying to federal tax, that isn't paying for your health care. Whereas in some of the other countries, not only do they have health care included with the tax that they pay, but there are also benefits related to child care, child nutrition. And so I guess there's no such thing as a free lunch. Some of the other countries that have higher tax rates say that health care is free in that country, and it's not necessarily free. It's just that it's included with the income tax that people pay. So what I've referred to a couple of times before as progressive taxes, this doesn't mean progressive in the sense that politically progressive. It doesn't mean that. Progressive, it means that it's graduated, or that it's getting increasingly higher as income goes up. So this first column is the applicable tax rate, and then the second column is the taxable income. The first thing that you have to keep in mind is that a certain portion of the money that you make is tax-free. And there is a standard deduction that applies in the United States. You can either itemize all of your charitable donations and deductions, or you can take what's called the standard deduction. And the standard deduction represents how much money you get to make tax-free each year. And there are other credits that also increases the amount of income that you get to make tax-free. But once you've exhausted all of those deductions and credits, there's going to be some taxable income. And the first $10,275 is taxed at 10%. You can see the next tax rate of 12% applies to all of the income above $10,000. Now, this is where some people don't understand income taxes. And I was speaking to somebody a few years ago, and they thought that once you made $10,276, that all of your income was taxed at 12%. And that's not the case. Because if that was the case, you'd pay a lot more tax once you made $10,276 than if you only made $10,275. So like that $1 extra would expose you to a lot more additional tax. And obviously that would be kind of a crazy system, and it's a strange system, but it's not that crazy. So the first amount of money, the first tranche of money, the first bracket of funds, you pay 10% on that, and then once you're beyond that taxable income, so if you earn between $10,000 and $41,000 in taxable income, then you pay $1,027.50 plus 12% of the amount over $10,000. So what you'll recognize is that this amount that they're saying the tax owed, that is the 10% of the maximum amount in the first bracket. So this is just illustrating that as your income goes up, you paid 10%, and then you paid 12%, and then 22%, and then 24%. And so it gradually keeps getting higher. And so the way that you'd calculate it is that there's some base amount of tax that's owed plus a percentage of the amount over the bottom end of the bracket that you're on. So you can calculate it this way, your tax that's owed, or there are tables, and we'll look at the tables today. We'll open up a PDF file that illustrates how you could determine the tax that's due. How many people here have used TurboTax or some sort of online tax preparation software? Maybe about a quarter of the class, maybe a third. When you have relatively simple taxes, they make those programs free. But then as you earn more money and as your tax return gets more complicated, then you have to pay to use most of that software. There's there's a handful that are like actually free. But what I'll illustrate for you today is there isn't anything like magical happening in the background with those programs that would prevent you from filling it out yourself. Like if you've got the patience to read through the instructions, you've got a calculator and you know how to use it, then you don't necessarily need to use those paid software programs, and you could just calculate it yourself. And that's what we'll do today is we're going to go through a 1040 with an example person just to illustrate some of the terminology that applies when it comes to individual income taxes. So any questions so far about income tax or the notion of progressive tax rates? Do you think it's fair that the tax rates go up? Like, what's the rationale for that? What's the philosophy that says this is a reasonable thing to do, that the tax rate should be going up? Because sometimes people say we should just have a flat tax.
You don't use all that money if you make over like $539,000.
I could use all that money. I'd find something to do with it.
It would unfairly penalize people who earn less money because flat tax, they would have to pay more of their income.
So the idea that a flat tax would unfairly penalize lower income people, but doesn't this unfairly penalize upper income people?
I think it discourages people from wanting to strive to make more income because you get cynical about having more of your money taken from you for putting in more effort.
Okay.
Have you heard of I'm sure you've heard of the phrase diminishing marginal utility, right?
Mhm.
That comes to mind.
All right. John?
I'd say that doesn't really make sense because the whole idea of would you rather make 10% of $1 million or 100%
Yeah.
of 10,000.
Right. Yeah, so I mean, even above $539,000, they're still getting to keep, what is that, 63%? So there still is an incentive to make the additional dollar because they're getting 63% of it. What's your comment?
It's just raw perspective.
It's what?
It's just completely perspective.
It's perspective. I think the people who are in favor of progressive taxes, they say that the people who are more successful should be called on to support society more than those who are less successful. It's just the idea of nobody becomes a billionaire completely in isolation. People become billionaires in societies where they've got employees that are contributing to their financial success. The society has contributed to their success because it provided educated people to work. So, when Tesla has brilliant employees, Tesla didn't pay to make those employees brilliant. There were, state and local educational institutions that educated the people and provided the workforce, and the governments provided the roadway network to bring the materials into the factory, and the government provided the national security to prevent people from coming in and just stealing things. And so I guess the idea is that the people who've been really successful, number one, it's easier for them to afford to pay more than their share, because the poorer people, they're maybe having trouble just paying for food and utilities and their water bill and stuff, whereas more wealthy people have covered the necessities of life. But I mean, it's a matter of perspective. That's true. And I don't think that, there is like an absolute truth on what's the best way to do taxes. But those are some of the arguments that I've heard in the past, both for and against progressive tax rates. The real pity, though, is when there's so many loopholes that even though it's supposed to be progressive like this, that people with a motivated and sneaky attorney, a tax attorney, can get out of paying a lot of it because of just special interest laws that are built into the tax code. Okay, so what we're going to do today is, for a hypothetical person, prepare their taxes. So let me hand out the W-2 for this person and tell you a little bit about them. It reduces how much of your income is taxed. Yeah. Okay, does everybody have a copy of the W-2? Let me see if I can pull up the W-2 just so it's included in the video. Okay, does anybody else need one? Everybody's got it? Okay. So we have the W-2 for Charlie Day. And let me hand out the 1040 that we're going to fill out. We have to wait for extras over here. Any extras over here? All right, everybody's got the 1040 at this point and the W-2. All right. So let me, so you've got this W-2 that you're going to hold on to. Let me tell you a few more things that wouldn't be on the W-2. Okay, so Charlie Day has a Robinhood account. where he has bought Bitcoin. And so in 2022, bought Bitcoin. Okay, so that's just a bullet point we need to be aware of. Has a son. The son is Braden Day. Social Security number 206-714531. Mowed the neighbor's lawn, Charlie did, and made $800 in 2022 from that, from mowing. Bank interest. Had bank interest in the amount of $24.31, and then had some stock dividends. Didn't sell any stocks, and so there's no capital gains, but did have dividends in the amount of $419. Okay, so I've written all of that on the whiteboard, and we're going to go through the 1040 together. Let me see if I can find an editable one. This is a single person, single dad.
His dad's making him report his lawn mowing money?
No, Charlie's the one who mowed the lawn, not the kid.
Oh.
The kid is under 6. And so you'll see in a minute why it's significant that Graydon is under 6. So fillable 1040 from 2022. I don't think that's what I want. Okay, so everybody's got the 1040. Let's fill in the, first of all, single. Okay, first name, Charlie M. Day. Social Security number. That's on the W-2. 524835843. Kind of weird that they'd have the numbers go right over the line like that. That's the IRS for you. This is a single person, so there's no spouse to put in there. The home address you can see from the W-2 is 4565 McNugget Street. That's sweet. That is in Fairmont, West Virginia, 25476. Okay. Anybody know what this presidential election campaign thing is about? Long time ago, maybe like it's been 18 years or so, but in the olden days, presidential candidates wouldn't raise their own money. What they do is they just use this pool of government-provided money for their advertising. But there's a limit. Like, I think maybe that pool of government money would only give them like $180 million. And it's been about 20 years since any presidential candidate looked at that pool of money and said that was better than just raising it themselves and then being able to spend an unlimited amount. So what this is doing is it's just saying, do you want some of the tax that you pay to go to that pool of money that presidential campaign people used to use for advertising? It doesn't matter now. It's a completely moot point because it's been a long time since any of the presidential candidates used that fund. So you can check it if you want, but the money's not going to get used. Okay, digital assets. This is pretty new. Only in the last year or two has the IRS been asking people if during the year they acquired or disposed of any kind of cryptocurrency, including like NFTs. So it says, at any time during 2022, did you receive or sell or otherwise dispose of a digital asset or financial interest in a digital asset? Okay, so let's say that Charlie Day bought their Bitcoin on Robinhood and they're leaving the Bitcoin on the exchange. They're not taking it into their own self-hosted wallet. They would still have to answer yes here because they have a financial interest in the digital asset. So there's really no way around admitting it to the government. They want to know, they're going to keep track of who has money coming, or Bitcoin coming in or going out. Because if it's coming in, they want to have you on their radar because they're going to follow up later to say, hey, whatever happened to that Bitcoin that you got? So we'd have to say yes, that Charlie has digital assets. Okay, standard deduction. This would apply to a lot of you who are still in college. If your parents are providing more of your financial support, more than half of your financial support, then they can claim you as a dependent, and you can't claim the standard deduction for yourself. So if they're paying more of your living expenses and tuition or health insurance, if you just add up all of the money that you spent and consumed in a year, if your parents provided more than half of it, then they legally can still claim you. But in Charlie's case, nobody can claim him, so we're not going to check any of those boxes. He's not blind. He's not born before 58. So we'll leave that blank. Okay, we're going to list the dependent here. So this is Charlie's son, Graydon. Graydon Day. Okay, Social Security number. They want to know that so that they can keep track of people when it comes to the deductions and the child tax credit. It's a son. Now, the qualifications for the child tax credit is that the dependent has to live with you in the United States for more than half of the year to be able to claim them for the child tax credit. So if you have shared custody with a child, the person who the child lives with more than half of the time is who gets to claim them for the child tax credit. So let's say that Charlie had Graydon with him more than half of the year in the United States. And then in the instructions, it also talks about the income limit beyond which you're not allowed to take the tax credit. And I think that the income limit is well beyond $200,000. And so Charlie's going to be okay to take the child tax credit that we'll come to a little bit later. Okay, so this is just all kind of the headline stuff, demographic data, and so on. And now we start going to the money. So income section. There's a lot of different places that you can get income. Most people, their largest amount and the most common income is income from work, which is reported on a W-2. And that's what we have here is the W-2. So it says to look in box 1. So that's wages, tips, and other compensation. So if we just compare this W-2, it has the wages reported a couple of places. It's got it here in box 1 and then 3 and 5 as well. What you'll usually have is the wages that are listed in box 1 have been reduced by the amount that went into this person's retirement account. Because remember, you can put pre-tax money into a retirement account, and then that's going to reduce the amount of tax you have to pay in a given year. So how much Charlie actually made from Green Bank Enterprises, their gross salary was $83,281. And that's listed because you have to pay your Medicare taxes and your Social Security taxes on that full amount. But your income taxes are subject to that full amount minus however much you put into a retirement account. So that's why the $78,567 is less than the $83,000. So what we're going to put in the 1040 is, like it says, box 1 amount. So that is $78,567. You can just write this, by the way, in pencil on your handout that I've given you. Okay. Household employee wages not reported on Form W-2. That doesn't apply. Tip income not reported on line 1A. If we go back to the W-2, somebody who has a job in the service industry may have a lot of tips as a part of the money that they make. And so that would be already included on this form if your employer keeps tracks of tips, like, for example, from credit cards. But like if you're in a cash business and you got tips, but it's not on any kind of documentation, you're still legally obligated to report the tips that you received. So, like if you're a cab driver and someone gave you a cash tip, you're supposed to report it here. So Charlie doesn't work as somebody who's getting a tip, and so we leave that blank. Medicare waiver payments, that's an unusual thing, doesn't apply in this case. Taxable dependent care benefits, that would be reported if Charlie's employer had some sort of a nursery on site that provided free childcare to employees, because that would be a taxable benefit. If there was, a lot of people usually just pay out of pocket for childcare, but if you have an employer that provides it as a benefit, then that would be considered as a taxable thing that you have to report on this 1040. Doesn't apply to Charlie. Employer provided adoption benefits doesn't apply. Wages from Form 8919. If you didn't get that form, doesn't apply. Other earned income. Okay, this is where we're going to put in the lawn mowing. Charlie's an honest person. He's reporting all the income that he received, and so he had other earned income in the amount of $800 received from a neighbor. So it's on there. Okay, we know that Charlie received taxable interest. You'll notice that here's a column for tax-exempt interest. Do you remember that we talked about municipal bonds? And municipal bonds can be attractive to certain people who are in a high tax bracket because the interest that you earn is free of both federal and state and local tax. So you'd still need to report it here just because they want to keep track of things if you had municipal bond interest, but Charlie doesn't. Charlie has just normal bank account interest, which would be reported on a form, I think 1098. You'd get it at the end of the year in the mail, or it's on the website of your bank. So the interest that we're going to put here, 2431, is how much taxable interest. And then the dividends, stock dividends in the amount of 419. There's no IRA distributions. That means like if you took money out of your retirement account, Charlie's still in his working years, and so that doesn't apply. The pension and annuities doesn't apply. Social Security benefits don't apply. So where we're at so far is we want to add up the amounts 1A through H goes into 1Z. So you'll notice here it says add lines 1A through 1H. So that is 79,367 because that's the income from work. And then if we add in the work income and then the non-working income, which is the benefits, the dividends and the interest. If you go down here to box 9, it says add lines 1Z, 2B, 3B, 4B, 5B, 6B, 7, and 8. That's your total income. Okay, so the total income is the working income, the interest, and the dividends. So total income for Charlie Day last year, 82,217. Now keep in mind, this is just the IRS definition of total income, because in the back of our minds, what we remember is that Charlie also made some additional income, but it's been put into the 401k retirement account. So we saw that when we were looking at this W-2. Remember that the Social Security wages was 83,281. So that represented the actual income from his job. But this is talking more about from a tax perspective, because you get to exclude the amount that you put into a retirement account. 82,217 is the total income that's potentially subject to tax. So any questions so far? Okay. So adjustments to income from Schedule 1. I think Schedule 1 is something that you'd fill out if you have your own business. That doesn't apply in Charlie's case. So if you don't have a business, then you wouldn't need to do Schedule 1. Subtract line 10 from line 9. So we're going to repeat this 82,217 because it was 0 in box 10. Okay, line 12, standard deduction or itemized deduction. So if you gave money to a church and you gave things to Goodwill and you made a donation to Doctors Without Borders and you kept all those receipts, if it's more than the standard deduction, then you should itemize. And you're going to need to fill out Schedule A to list all of those itemized deductions. But if all of your charitable donations are less than $12,950, then there's no need to itemize. So let's just say that Charlie didn't do donations more than $12,950, and so he's just going to take the standard deduction for a single person. So $12,950 is the standard deduction. Qualified business income deduction. Charlie doesn't have a business. So then we add lines 12 and 13. So $12,950 again. And then we're going to subtract. Now this $12,950, that's how much you can work and pay no tax on. So we're calculating the taxable income in line 15. It says to subtract 14 from 11. So here's 11. This was the income that was potentially subject to tax, but we're subtracting out the standard deduction. So that leaves $69,267. Okay, so that's the taxable income, and that's in bold. Usually it has things in bold if they're pretty important, like it's the main part of the tax return. So many of these rows don't apply, but taxable income we definitely would want to know. Okay, so the next page, the back side of the form, is where we keep track of all the credits and payments that apply. And we'll see if Charlie is either overpaid or underpaid. What you want to have, I guess, from a financial perspective, because the government doesn't pay interest when you overpay them. You know, when you get your refund the year afterwards because you overpaid, you're just getting the money back with no interest. So, like, it makes more economic sense to owe money, but not too much, because if you owe a lot of money, then you have to pay the government interest, even though they don't pay interest when they give you back your refund. But I guess the simplest thing is just if it evens out perfectly and you don't get a refund and you don't get a credit. But we'll see in Charlie's case whether he's going to have to write a check or he's going to be getting a check. Do you have a question?
Yeah, does all other self-employed income go into H, other earned income? So, any form of self-employment?
No, if you have your own business and, you know, like you've registered with the state attorney general.
So like if he made mowing into his own,
Like if he made it a business, he'd fill that out and put it on the Schedule 1.
and he could get tax deductions off of it?
If he had expenses, he could like subtract out his expenses. And if it's a qualified, there was this phrase in here, qualified business income, certain categories like consultants, there are certain businesses that get an additional deduction even more.
Like fuel work as a deduction?
Yeah. Do you have a question?
Yeah, about the Bitcoin, so you check the box that if you have done that.
Mm-hmm.
When you get, is there something on it that you have to report the amount that you bought?
No. No, but if you sold it and you made money, then you'd have to report the either capital gains or ordinary income depending on how long you held it. If you held it for less than a year, it's going to be taxed as ordinary income. More than a year, and it's going to be taxed as a capital gain, which is at a lower interest rate, a lower rate.
What lines on here would those be?
That would be separate forms. Yeah. Like if you have stock or real estate sales, then that triggers additional forms that you'd have to fill out. Okay, let's look at the tax tables because we want to find out for this the taxable income, $69,000, how much is the bill going to be? This is always nerve-wracking when you're worried that you may have underpaid. So let me open up the tax table. It is maybe the most boring booklet ever. So taxable income was $69,267. I could just read this all day. So $69,000. You go down here. So $69,250 to $69,300. Yeah, we're in this range. Now look at column single. If you're single, you pay more tax than if you're married. Filed jointly. Why? I don't know. I don't know. But the tax is $10,858. $10,858. So let's go back to the 1040 here. So from the tax tables, it was $10,858. How much got withheld on the W-2? Go to the W-2, see box 2. Charlie only had 3,431 withheld. So Charlie's getting nervous right now. Charlie's thinking, oh my goodness, my tax is 10,000 and I only had 3,400 withheld. Charlie's wondering if he's going to have to pay like another $6,000 in taxes. But luckily, Charlie has some credits coming, and so it's not going to be that bad. Okay, so amount from Schedule 2. Charlie doesn't have a Schedule 2, so now line 18, we just add two things together. It's the same 10,858. Child tax credit. Thank goodness for Graydon, because Graydon is worth $3,600. He's under 6. If Graydon was 7 to 18, Graydon's only worth $3,000. But Graydon, as a youngster, is worth more. All right, so $3,600 credit. This is refundable. Even if Charlie didn't have any taxes due, he could still get a refund from the government in the amount of this $3,600. Okay, there's no Schedule 3. We're adding together lines 20 and 19, so that's 3,600 again. Okay, then subtract the tax due from this, subtract the child tax credit from the tax due. That leaves $72.58. So that's now how much Charlie is on the hook for. Oh, no, 72.58. Yeah, it's the 10,000 minus the child tax credit. So that's how much tax they have to pay this year. 72.58. Okay, how much actually has he paid so far? This comes from the W-2. It's $34.31. Okay, so then there's also a line on here for an additional tax credit. It says to fill out Schedule 8812. So this is a temporary thing, like it's been renewed several years in a row. But if you're under a certain income threshold, around 200,000, then your kids are worth another $2,000. So what that does is it's going to reduce how much tax he has to pay, because it was $34.31 is if we add up the payments and then we add the additional credit of $2,000. So then the total payments, the actual amount that was withheld plus the value of the credits is $5,431. We've got 2 minutes left, but it will be enough. Okay, so this is saying if line 33 is more than 24, then this is how much you overpaid. So the tax is $7,000. The payments are $5,400. So he did not overpay. Charlie is not getting a refund check this year because the total tax of $7,000 is more than the payments plus the credits, the additional credit. So we have to skip over the refund section, amount you owe. Subtract line 33 from 24. So that is $72.58 minus $54.31 means that Charlie is going to have to write a check for $1,827. So then they have instructions on how to pay at that website, irs.gov/payments. And you'll notice here on line 38, estimated tax penalty. If you owe more than $1,000, you might have to pay a penalty for underpaying during the year. Because what you're supposed to do is if you know you're going to owe money at the end of the year, you're supposed to pay quarterly, like throughout the year. But if you got a refund last year, then they don't make you pay a penalty this year. Because like Charlie's thinking, well, my situation was so similar last year to this year, so most likely Charlie wouldn't have to pay a penalty related to this. It would just be the tax due itself. So That's the long and short of income taxes. It's 12:50. We're out of time. It's been a great semester. I'll see you back in here next Friday for our final exam.
So, you have a, what